Welcome to the April 28th, 2025 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. What is happening in the markets? We're going to cover that. Are bonds the answer? And technology. Wow, how low does it go? Well, let's cover where we are first. This is the Dow year to date. Two numbers to remember: 45,000 high, 36,600 low, nearly 20% difference. And it says, okay, where do we go from here, right? And what are the other solutions out there? So I'm going to bring up a couple of categories you may not have thought about that have helped us in past bear markets and could be a better opportunity as this thing unfolds with the tariff disruption. As we covered last time, all the disruption with the Chinese imports at a halt. You got Chinese-made rubber duckies and Buzz Lightyear dolls floating around in the Pacific. They're not going to make it to Walmart, and they're not going to add to GDP. And multiply that times the equipment and the washing machines. It was interesting, but just because we talk about something here doesn't mean it's a recommendation until you come down and get a plan with us. I'll tell you how at the end. But in this case, you can see Trump calling Fed Chair Jerome Powell Mr. Too Late, total loser on social media. And there's the Monday meltdown. We still were above where we were here on the April 7th meltdown. But in any case, we go forward. The week was a recovery. What happened? J.D. Vance and Prime Minister Modi of India met, and they have a roadmap for a trade agreement, which would be huge. Apple had already alluded to moving their factories, but that's still going to be disruption, and there still may be an iPhone shortage that's going to subtract from second quarter GDP. So you're going to rock around in this range. You might make a new low. Where do we go? Well, let's look at tech. Technology stocks had the earnings reports this week. That led to part of the rally. The technology stocks so far that have reported 15% gains in profit over last year. Wow, have they corrected enough? Some of them not at all, and some of them have a lot further to go. I'll show you that in a second. 17.5% earnings growth for 1/3 of the S&P companies reporting so far. That is a great number so far. And it says, hey, first quarter earnings coming in better than projections despite all the disruption. That's good news. That's expected to continue, but it'll be reduced because of the tariff disruption. And there'll be some great bargains. This is the tech index so far. After a 5% gain this week, the NASDAQ 100, which is basically tech stocks, is a -8% for the year. On the QQQs, there's another lesson here, and that says, well, I'm about to get to the lesson. Let's do the bond fund first. All right, this is the best bond track record. Part of the question I ask in the YouTube header, are bonds the answer? And the answer is sometimes they're better. There are 4 components to McGowanGroup Wealth Management portfolios. By the way, I'm Spencer McGowan, President, McGowanGroup Wealth Management. Your financial weatherman. There are 4 components to our managed portfolios. One is global lending. That's what you see right here. I'm going to cover one of the best fixed income records, best bond records that I know of after all these years of research. Global high yield, global lending, be the bank. Safety and income, tactical safety to get ready for corrections like we're in right now. And you can deploy it to growth with income and growth and innovation, the other 2 categories in the McGowanGroup Wealth Management model. This we've used since 1992. What's the score? Well, from inception, this is a 9.6% average return if you reinvested. Well, let's say you wanted to live on the dividends, which have been anywhere from 7 to 12%, depending on the price. Well, you would still have a 6% return even if you spent all the income. But what if you were catching that at a 2020 meltdown? Wow. What if you were catching that at 2008, which we did in the managed accounts? Remember, not a recommendation for your portfolio till you come down and get a plan, or Zoom and get a plan. Anyway, how did we recover from the 2008 bear in just 9 months? And we did it with record income. That was one of the components. And you can see we recently had a dip. If you go into pandemonium panic, you got a target picked out, it's a great time to reinvest dividends in the better parts of portfolios. Here, this is the energy infrastructure category. If you own the pipeline, you earn money every day from oil and gas flowing through that pipeline. Wow. So from inception in 2017, about an 8-year time period, 10.6% average if you reinvested, 8% if you wanted to live on the dividends. That's pretty good. Wow, that says energy infrastructure plays a part. And the best bargain point was right here. You could buy these things at over half off. Wow, and that was during the shutdown. These are assets that actually pay cash flow and earn it every day. That's a good solution too. And it says you don't have to answer the question, should I buy NVIDIA or Palantir today? There may be other components that you need in the portfolio, and this year is going to give you a great opportunity to add those at a relative bargain price. Now, tech stocks, how bad could this get? Most people don't know this. They've heard of the tech wreck. What happened? Well, let's go back to 1999. Tech stocks partied like it was 1999. And there was the NASDAQ 100, mostly tech. It comes out as an exchange-traded fund, and it goes from 50 all the way to 120. Wow, pile on. Well, not so fast. 120 down to 20 by October of 2002. Wow, how long did it take to recover? Well, let's see. Here's the 2008 meltdown. It didn't even really get back over 60 before the meltdown, even though the rest of the market hit new highs in 07 before that meltdown. Nobody wanted stocks here in March of 09 at the turn. But anyway, since then, it's been a great track record, except for the fact it took you 16 years to break even at that point. That's why you need some components in the portfolio that pay you real cash flow that are not dependent on the market. We do have a growth and innovation sleeve in the managed accounts, and that is based upon companies at reasonable multiples, good growth rates, bought at the right time, we hope. And this category, you can see by this run up to 2017, it's actually been good since then. What happens to tech from here? The answer is probably this downside and this upside over the next 5 years. It's going to give you some good entry points, but I wouldn't want to ride that with my entire portfolio. Thank you for tuning in. Go to networthradio.com. Contact us there to set your time for a brainstorming session. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.